Right. So this video is going to talk about how we get this steady state, for the capital stock in the growth model, the Solow growth model that we've covered. So I have an earlier video where we talked about the production function and using that as a way to think about relating the capital stock to aggregate output. So I've drawn the production function here, and we know that as we have more capital, we're able to produce more output. So we have this relationship between output and in capital. So in one sense, a bigger capital stock allows us to have more output, and output is ultimately our consumption and standard of living. So in one sense, having a bigger capital stock would appear to be like a good thing, but there's a limit to that. And that's really where we're going to get this, what we call this steady state. Now, one thing we have to do here is that we're really explicitly have to bring in what's known as a dynamic element. We have to realize that this is a snapshot of the economy. It's showing, say, like production in a given month or a given year. And then we can come back and have a similar picture to show production next year or next period. But the capital stock in the next period is going to depend on with the actions that we took today. So the present and the future are linked, and linked in ways that our actions that we're taking today are going to affect what's possible in the future. That's what we mean when we have to have some kind of a dynamic model. And so we have to think about the capital stock is going to change from 1 year to the next based on our level of capital and output today, but more importantly, investment and savings, because investment is what gives us capital in the economy. So investment adds to the capital stock. So as we try to think about this dynamic element, we realize more investment we have in the economy today, well, that investment can add to the capital stock, and we can have a bigger capital stock tomorrow. That means we can produce more in the next period and have a higher standard of living. And again, we're trying to think about what's going to, at what point does this capital stock going to stop growing, and what leads to that? Well, when does capital stop growing? Well, one thing we said in the video, when we talked about this in the video on the production function, is that the production function, because we're holding labor in the economy constant, and then other factors of production like natural resources, output is depending on capital. So as we add more capital, holding other inputs constant, diminishing returns are going to say. The law of diminishing returns will apply in this case. Diminishing returns tells us how much extra output we get when we have some extra capital. And it really tells us the reward we get in terms of additional possible production in the next period from investing today. Now, savings have to be rewarded, because when you save, you're giving up the possibility of consuming today. And in fact, because people are impatient, you have to get what you could consume today plus a little bit extra. You need to be rewarded to be willing to save. And of course, you have to have savings to have investment. And so, in effect, because of diminishing returns, the reward from increasing the amount of savings declines over time. And it's that declining reward to savings that at some point is going to lead to people to decide to say, well, we don't want to save all that much more. We're getting to a point where we're not getting enough of a return from saving in terms of an increased possible consumption in the next period to make saving worthwhile. So diminishing returns means that we're going to cap the return on savings, and that return on savings is starting to decline, and that's going to give us a limit to the amount of savings that people in this economy would want to do. And this would depend on exactly what we talk about in terms of their rate of time preference, how patient they are versus viewing the present versus the future. But for a given level of time preferences, diminishing returns means we're going to, or at some point, we're going to get up to a point where the supply of savings will stop going up. So we'll have a fixed supply of savings. So with a fixed supply of savings, when do we get to no longer having the capital stock increase? Well, because with a fixed amount of savings every period, we can have investment every period. We're adding to the capital stock. But that doesn't mean that the capital stock continues to increase forever. And that's because there's another factor that we have in here, and that's depreciation. If you're a business major, you'll take accounting classes, and they'll talk about depreciation in accounting classes. And they have depreciation schedules. We're not worried about that. What we're worried about here, we're using depreciation in its very fundamental term of saying machines wear out, tools break. Right? Capital are produced factors of production, and tools break, machines wear out. Sometimes you can keep wearing them, but using them, but you have to use more and more maintenance and repairs to keep them working. That fact of maintenance and repairs, and then other machines and tools breaking and having to be replaced, that's what we mean by depreciation. And if you assume that a certain a fixed percentage of the existing capital stock is going to wear out every period, when you have a bigger capital stock, you have more depreciation. So the way to think about this is, suppose 10% of the machines wear out every period. When you have a capital stock equal to 100 units of capital, that means 10 units of capital would be wearing out in a given period. So if you had a capital stock of maybe 100, you have one level of depreciation, maybe 10 units of capital wearing out. As you get to a larger capital stock, maybe 200, now with that same rate of depreciation, 20 units of capital wear out every period. What this means is that with a larger capital stock, the amount of depreciation, the amount of capital that's wearing out or being used up every period is increasing. So depreciation is increasing. We have to invest more and more simply to replace the machines and capital that are wearing out every period. A larger capital stock requires more investment simply to offset depreciation. So when does the capital stock stop growing? Well, it'll stop growing when the capital stock gets big enough that depreciation is just equal to investment. Because remember, investment is going to end up being capped here or limited because of the diminishing returns, and the total amount of savings in the economy is going to be limited. And the capital stock will stop growing when all of that savings and all of the investment it allows goes into simply replacing the portion of the capital stock that wears out every period. So if you had, like, say, enough investment to invest, say, 30 units of capital, you have 30 units of capital in this model in a period. Well, if 10% of the capital stock wears out every period, what you're going to end up having to have is a capital stock that's going to be of 300 units. When it gets to 300 units, the depreciation, 10% of the capital stock, is 30 units. And if that happens to be the level of savings and investment, the level where savings is capped in the economy, that's going to give us the result that we need, that all of the investment is simply going into depreciation. And when we get to that level, wherever it is, capital is going to be fixed then at the steady state. So we might say K-star is a steady state capital stock. And then that would give us the level of output. And then that would give us a level of output off of the graph here, and that would give us the steady state level of output. And we will have, in effect, solved or come to a solution in this necessarily dynamic model. Again, the steady state is a way to have a relatively easy way to solve an otherwise very complicated dynamic model. A dynamic model, again, dynamic meaning that the capital stock in the next period is going to depend on what the capital stock this period was and the amount of investment we had. And steady state is a way to think about an equilibrium or solution to the model where the capital stock is no longer changing. And then that's what we could say in terms of the level of output. And then further, the chapter will talk about, and that's how essentially we solve the Solow Growth model. We get this steady state outcome in the Solow Growth model. And countries with a higher capital stock will have a higher standard of living, but they'll still be at a steady state. And then we can take that basic model to then try to think about again how you can make comparisons across countries, and then how if you have new technology to shift the production function, you can think about having continuing growth in the model. So again, this is what we mean by the steady state. It's a relatively, it's a way we go about often trying to solve what would otherwise have to be a dynamic model, and dynamic models otherwise would get very, very complicated, very messy, way beyond what we want to get to in this class. So what we're really talking about here is this steady state in the capital stock, and this hopefully gives you a little bit of sense of what's going on behind this.